Hey, good afternoon, everyone, and welcome to our live product walkthrough and QA session. My name is Dan, and I'm part of the Snap Projections customer success team. Just before we get started, I just want to confirm everyone can hear me. So if you wouldn't mind just confirming that by typing in yes within the GoToWebinar control panel, it would be found under the questions tab. So yeah, you can just put a simple yes or smiley face, just so I know you can hear me. That would be great.
Hey, Dan, I can hear you. It's all good.
Okay, so I will proceed. Just in regards to the agenda for today, we're going to be going over in detail the first section of SNAP, which is the scenario setup, covering the importance of it, navigating it, and setting the assumptions in regards to entering the financial details and adjusting them, as well as a brief introduction to the planning pages. So before we get into the tool itself, just in regards to why setting up the scenario setup is such an important piece, it's the foundation of effective financial planning in SNAP projections. It serves as the starting point for building accurate and personalized projections by defining key financial details such as income, expenses, assets, liabilities, and tax assumptions. A well-structured scenario ensures that the advisor can provide realistic, data-driven insights to their clients, helping them make informed decisions about their financial future. By carefully setting up each scenario, advisors can model different financial strategies, assess potential risks, and refine plans to align with the client goals. Without a solid scenario setup, projections may lack precision, leading to less meaningful or actionable recommendations. And then in regards to just navigation, so navigating the scenario set page in Snap Projections is essential for effectively building and managing financial plans. The page serves as the central hub where advisors can enter key client information, again, including income sources, expenses, assets, liabilities, and tax settings. So understanding its layout and functionality ensures a smooth workflow, allowing advisors to quickly input data and make adjustments as needed. Each section is designed to provide a clear snapshot of the client's financial situation with built-in calculations that update in real time. Familiarity with the scenario setup page enables advisors to streamline their planning process, ensuring accuracy and consistency in their projections while saving valuable time. Okay, so I'll hop over to my Snap projections account. So obviously when you log in, you're going to be greeted with the dashboard here. So in the essence of saving time, I've created a sample plan for our clients, Bill and Vicky Spicer. So I'm just going to open that up for us and going to the scenario setup. So this would be the first page that you're greeted with when creating a new client. So the first tab here is client information, so very basic. So we're entering first name, last name, dates of birth, the province where they reside, and if there is a spouse, we're also including the spouse's information here. So just moving on now to the general assumptions page. So starting at the very top, you'll notice that you can now select a year in which our projection begins. Since we are near the beginning of our year, I'll proceed with using 2025 for the start year. Keep in mind, as the year progresses and we are nearing the end, it may make more sense to begin your projection in the following year, and this is where you can direct Snap to do so. So this would be selected here. And again, if we're, for example, near the end of 2025, you could bump the plan into 2026. So next up, obviously a big piece is when the clients plan to retire. You can enter this here, and I've selected ages 65 for Bill and age 63 for Vicky. You can also select how long you want your projection to run for, and you can see I'm running my projection to ages 100 for Bill and 98 for Vicky. So just moving down here, so after this we can specify assumptions around inflation rates and rates of return. These values reflected here are SNAP's defaults, which are FP Canada's recommendations. You have the options of adjusting these rates to your preference or simply leaving them at the defaults. In regards to rates of return specifically, we recommend that these defaults reflect the net returns, which accounts for investment management fees. If by chance you have updated these values and you would like to use them on a new client, for new client scenarios in the future, you can save your selections and save current page settings for new scenarios. Now, when you create a new scenario, these defaults that you've adjusted will be saved for future projections. Okay, so now that we have the general assumptions covered, we can move over to expenses. So here you can see the base expense is the first entry. It's important to note that the base expense is what the client intends to spend in retirement. This is not their assumed current expenses, unless of course they are already retired. So this amount should also not reflect any other expenses such as mortgage or debt payments or other items like insurance premiums. These expenses are included in future sections of the scenario setup. For this example, Bill and Vicky would like to spend $160,000 during retirement, and this will be indexed to inflation. You'll also notice the additional expenses section. This is where you can include one-off expenses, such as large purchases like a vehicle or an occasional vacation. So you can see here, I've entered a vacation expense. I've described it as the vacation. It will be in the amount of $10,000. It will be joint between Bill and Vicky. I'll index this to general inflation, and I'm going to run this from ages 65 to age 80, and the frequency is going to be every other year, so every 2 years. In regards to a new vehicle, so it looks like Bill would like to purchase a new truck, so I've entered the amount of 65. Again, this is going to be a joint expense with Bill and Vicky. I've indexed this out to general inflation, and I've started the age at 68 and to 68, so this will only occur in that year for that additional expense for the truck. So I'm just going to move on now to incomes. So this is where you include any employment income. So you can see here, I've updated this to reflect Bill's income of $150,000. I've labeled it as employment income. We're going to index this to general inflation throughout the projection up until retirement. This is a taxable income and it's RRSP eligible. The other thing you may notice is Bill anticipates receiving an inheritance. So I've also included this under the income section. So again, a description of what it is, the anticipated amount. I have not indexed that to inflation. The type of income is other, and because of it being an inheritance, it is not taxable. And again, I am assuming that this is going to be received at age 68. The other thing to note here, if the client has a defined benefit pension plan, this is where you could include those details, in which case Bill does currently hold a defined benefit plan. So I've included the start age at 65 when Bill retires. If he was anticipating retiring before age 65, I've included what that benefit would be, the survivorship percentage, the indexing rate, and then from age 65, I've included the amount of 42,000, 50% survivorship, and indexing at 1.5%. So typically you're able to gather this from your client's pension statements. They usually should receive one at least once a year to gather that information. So just moving over now to Vicky, just by simply toggling over at the top left-hand side here to Vicky, I've included Vicky's income of 105,000, much like I did Bill's, indexed to general inflation, its employment, its taxable income, and it is RRSP eligible, and that will run up until the age of 62, the last year before full year of retirement. Okay, so I'm gonna hop over now to the asset section. So starting by adding a financial asset, you can see here I've added several accounts, and I'll just hop back to Bill, sorry. I've added a few accounts for Bill, starting with a non-registered portfolio. You can provide that description, the value, the cost base, because it is a non-reg portfolio. It's great to get the cost base of that account. The type of account, making sure it aligns with your description by simply clicking on the drop down and selecting the appropriate account type. It's a joint account with Vicky. And then here you can see I've allocated the asset mix to 20% fixed income and 80% equity. Again, based on our default rates of return on the general assumptions tab, Snap will come out to the average rate of return based on that mix. And I've done that now for each of the RSPs and TFSA account. I'll hop over to Vicky where you can see now the joint account is also included under her name. However, she does have her own RSP TFSA, but what you will notice here, she also holds a defined contribution pension plan. So while we're on this page, I just want to highlight a couple important pieces. Since they both hold TFSA and RSPs, you can see here there are tabs for each of those types of accounts. So if we first move over to the TFSA, you can see here TFSA contribution room for 2025. So this is where you can include their lifetime contribution room for the TFSA. By default, SNAP will include the annual maximum for this year, which is 7,000. However, if you were able to gather this from your client, for example, from a Service Canada statement, you can include that amount here, which we've done for Vicky. And the very same thing can be said for the RSP. You can also include the RSP room up until 2025. So for Vicky, it would be 82,000. Just keeping in mind, SNAP's default will be 18% of Vicky's income up to this year's maximum. But again, if you have that information, for example, from a notice of assessment, you can include it here. Another thing to note, again, Vicky holds a defined contribution pension plan, so she and her employer both contribute to that account, and we can indicate what those contributions are by going over to the employer matching section here. So you can see here we found the defined contribution plan, and we're basing those contributions off of Vicky's employment income, and she is contributing 6% and her employer is also contributing 6% to that plan. Last but not least, I'll just toggle back to Bill. It's under both of them, but it's their principal residence. So under the real assets header, you can include any real estate that the clients may own simply by entering the value. You can enter the cost base, the anticipated appreciation on that asset, and then you can indicate whether it's a joint asset. And since this is their principal residence, the capital gain tax would not apply to this specific property. Okay, so now just moving over to the debt section. Bill and Vicky just have the mortgage outstanding on their principal residence. So I've entered those details here. Again, starting by entering the balance, the interest rate. The payment is a combination of interest and principal. The monthly payment amount, that this is a joint expense. And here you can see I've linked it to the principal residence on the assets page. So why it's important to do that, in this case, Bill and Vicky don't plan on selling their property, but for example, if we were to do an update in the future and that involved the sale of the property, linking the two, debt and asset, will ensure that that mortgage is paid off if the asset is sold. Okay, so I'm just going to hop over now to government benefits. So here is where we can include the CPP and OAS benefits for Bill and Vicky. By default, I've updated them now for Bill and Vicky. However, by default, the CPP will equal the national average. So if you're not aware of your current clients, what their available benefit would be, you could use the national average, but of course, if you have that information, this is where it can be updated by entering it in here and when they plan to take that benefit. And since Bill and Vicky have been lifetime residents in Canada, we're also assuming that they're going to receive maximum benefits for OAS. And then you can also go over here and enter that information for Vicky as well. So I'm just going to take a quick pause. I don't see any questions coming in, but if you do have them, be sure to include them again in that questions tab in your GoToWebinar window.
Thanks, Dan.
Okay,
Looks good.
okay, thanks, Lee. Okay, so for Bill and Vicky's case, that's it. We've entered all the information required for them to create their first base projection. You will notice too that there's areas such as insurance and education. In this case, Bill and Vicky have no children and they have no insurance policies, but this is where that information could be input. So we're nearing the end of our time together. However, let's take a quick look at the next section of SNAP, where you can see the output of the data we just entered. So I'm just going to move over now to the planning pages section of SNAP. So again, this is the output of all the data that we have just entered leading up to the end of the projection. And I'm sorry, I'll go to the combined of Bill and Vicky. So again, this goes down all the way to when the anticipated end of the projection begins or ends, sorry. And I just want to cover a couple years. So I'm going to go over a pre-retirement year in this window as well as a retirement year. So I'm just going to start at the very top here in 2025. So we have the combination of Bill and Vicky's income, and you can see the breakdown by expanding that out here. The total taxes payable on that income. Afterwards, we move into the financial assets section of the tool. So this is a combination of their assets. So we have that joint non-registered portfolio. We have both of their TFSAs. We have both of their RSPs, and we have Vicky's defined contribution pension plan. And then moving over to real assets, we have the value of their house, and then the outstanding mortgage and annual payment on that mortgage. And then here we have their total net worth, and then you can see here tax on estate in any given year. You're able to see what would be due on the estate. So moving back over to the left here, you can see here we have the first full year of retirement highlighted in bold for 65 and 63 for Bill and Vicky. And we have this $160,000 anticipated spend goal. So again, moving over, we can now see that vacation that we had entered as an additional expense being inflated to inflation. And then again, moving over, we now have Bill's defined benefit pension. Benefits would include CPP and OAS. If we expand that out, you can see the CPP and OAS benefits coming in at retirement. And again, once the retirement years begin and cash flow management is turned on, this is where SNAP is doing the heavy lifting for you. And what I mean by that is it is starting to draw on their various financial assets in order to meet any obligations such as a mortgage and of course their anticipated spending of $160,000 in today's dollars. So you can see here we're taking funds from non-reg, RSPs, and then we come up with the total withdrawal from their portfolios over here. So that's a very big highlight of the planning pages. There's much more to go into in regards to that. However, I'm going to save that for a future session. And I don't see any questions coming in, but I'll give you guys a few seconds. If you do have any, please be sure to include them. Okay. So before I leave you, I just want to highlight a couple things within Snap. What I found super helpful was our help center. So that's always available to you. So this is the window that brings up. So for example, if you had questions about how to enter a defined contribution pension plan, you could simply type that into the search bar here. There's various articles, how-tos, videos on how to model certain things within Snap. And then for future sessions, what I recommend is going to our webinar section. And then here you can see the live support sessions, and you're able to also see upcoming sessions and where to register and how to register. So yeah, again, that concludes it. We're a bit early on time. I don't see any questions coming in. So if there are no questions, I'm going to let you guys go and enjoy the rest of your day. Thanks for joining, everyone.